Hi friends, in this module we will cover chapter 3 admission of a partner from question number 47 to 48. Before we move on to solving the question, please note that you can download the contents that we discussed during the module by clicking on the link in the description. Also remember to subscribe to our channel. Now let's move on to the question number 47. Vimal and Nirmal are partners sharing profits in the ratio of 3:2. Following was the position of their business as on 31st March 2018. On 1st April 2018, Kailash agreed to join the business on the following terms and conditions. He will introduce 40,000 as his capital and pay 20,000 to the existing partners for his share of goodwill. The new profit sharing ratio will be 2:1:1 respectively for Vimal, Nirmal and Kailash. A revaluation of assets will be made by reducing plant and machinery to 35,000 and stock by 10%. Provision of 1,000 is to be created for bad and doubtful debts. Pass journal entries for the above arrangements and give the balance sheet of the newly constituted firm. Also specify the sacrificing ratio. Okay, so here we have two partners, Vimal and Nirmal. Their profit sharing ratio is 3:2. They admitted a new partner, Kailash, and he is to bring 40,000 rupees as his capital and 20,000 rupees as his goodwill. After admitting the new partner, the new profit sharing ratio is 2:1:1. Okay, the first thing is that we need to find the sacrificing ratio. So let's find the sacrificing ratio. Vimal, his original share is 3/5 minus his new share 2/4. So his original share is 3/5 minus 2/4 his new share. That is equal to 2/20. And Nirmal, his original share is 3:2 was the ratio, so his original share is 2/5 and his new share is 1/4. That is equal to 3/20. Now we got the sacrificing ratio. The sacrificing ratio between the partners is 2:3. Now we have several transactions here. We need to pass journal entries. First transaction is the new partner is going to bring 40,000 as his capital and 20,000 as goodwill. So let's journalize that. So here the new partner is bringing in money. So bank account debit to Kailash capital and to premium on goodwill. So here it is 40,000 as capital, 20,000 as goodwill. So in bank account you will get 60,000. Now whatever goodwill he bought, that has to be distributed to the old partners in their sacrificing ratio. So premium on goodwill account debit, 20,000 is the goodwill, and we already found the sacrificing ratio, which is 2:3. So to Vimal capital to Nirmal capital. So 20,000 divided in 2:3 ratio, it's going to be 8,000 and 12,000. That's the sacrificing ratio. Now we have the different transactions mentioned here. So a revaluation of asset will be made by reducing plant and machinery to 35,000. Currently the plant and machinery is at 50,000 and it's going to be reduced to 35,000. So there is a revaluation loss of 15,000. Then the stock will be reduced by 10%. So current value of stock is 40,000. 10% of 40,000 is 4,000. Then they also mentioned provision of 1,000 to be created for bad and doubtful debts. So 18,000 is the current debtors, and we have to create a provision for doubtful debts of 1,000. So let's put the journal entry together for this. All these things are revaluation loss. So revaluation account debit. There is a loss, so revaluation account has to be debited. So revaluation account debit to plant and machinery, to stock, to provision for doubtful debts. So plant and machinery, from 50,000 it has to be reduced to 35,000. So the reduced value is 15,000. Stock, it is 4,000. 10% of 40,000. Provision for doubtful debt is 1,000. So adding this together, we are going to get 15 plus 4, 19,000 plus 1,000. It's going to be 20,000. Okay, whenever there is a revaluation account, we have to move the revaluation balance to partners' capital in their original profit sharing ratio. The original profit sharing ratio is 3:2. So here it is revaluation debit balance. So we have to debit the partners' capital account. So Vimal capital account debit, normal capital account debit to revaluation. The balance of revaluation account is moved to partners capital. So here the profit sharing ratio is 3:2. So it's going to be 12,000, 8,000 and together it's 20,000. Okay, now we need to look at the balance sheet. What are the items that we need to adjust? So one thing is, here there is a profit and loss account balance that needs to be distributed to old partners in old profit sharing ratio. There is a goodwill existing in the books. So when a new partner is admitted, we shouldn't have any P&L account balance in balance sheet or goodwill. So this has to be distributed. So we will pass a journal entry for that. First, we will transfer the goodwill to old partners capital account, that is Vimal capital account debit, normal capital account debit to goodwill. That is 6,000, 4,000 and 10,000. The original profit sharing ratio, which is 3:2. Now P&L, we have a credit balance. So P&L account debit to Vimal's capital to Normal's capital. Amount is 20,000. If it is divided in 3:2 ratio, it's going to be 12,000 and 8,000. Okay, we completed the journal entries. Now the question says we have to prepare the revised balance sheet. So we will move on to preparation of balance sheet. First thing is, we should find the cash balance, cash or bank. So originally we have 14,000 as cash balance. Now how much we are getting here? We are getting 60,000. 60,000 plus 14,000, it's going to be 74,000. Then we have debtors. 18,000. The revaluation says we need to create a provision of 1,000. So we are creating provision less provision 1,000. The debtors balance will be 17,000. Then plant and machinery, the question mentioned that the original value of 50,000 has to be reduced to 35,000. So based on that journal entry, we are keeping the plant and machinery value 30,000. Stock, there is a 4,000. So if you look at the journal entry, stock is reduced by 4,000. So that's going to be 40,000 minus 4,000. It's 36,000. Then creditors, there are no changes to the creditors. It's 20,000 in the original balance sheet. We are keeping 20,000. And capital, Vimal, Nirmal and Kailash. So Kailash is bringing 40,000 as his capital, so we know it is 40,000. For others, we need to see the original balance. The original balance for Vimal is 60,000. Okay. Now 60,000 here, the goodwill is we have to calculate this. So Vimal, it is 60,000 his original balance, and now his capital here is credited with 8,000. So if you see this 8,000, so it's going to be plus 8,000. Okay, and then if we come down, there is a debit of 12,000, so it's going to be minus 12,000. Okay, then here again a debit of 6,000, so it's going to be minus 6,000. Then if you come down again, you have a credit of 12,000. So credit means again we are adding 12,000. So put together the value is 62,000. Same way for Nirmal, his original capital balance is 32,000. So there is 32,000 for Nirmal. On 32,000, if you see, it's going to be Goodwill Distribution, it's plus 12,000. Here there is minus 8,000, and when you come down, it's minus 4,000, and when you come down, it's plus 8,000. So capital balance for Nirmal, it is 40,000. 62,000 and 40,000. So we'll put the balance here. Where Vimal, it is 62,000. Nirmal, it is 40,000. Put together all the capital, it is 1,42,000. Now the balance sheet total is 1,62,000, and asset side also it is 1,62,000. So we completed question number 47. Now let's move on to question number 48. X and Y share profits in the ratio of 5:3. Their balance sheet as at 31st March 2015 was as follows. They had been decided into partnership on 1st April 2015 with 1/8 share in the profits. Z brings 20,000 as his capital and 12,000 for goodwill in cash. Z acquires his share entirely from X. The following revaluations are also made. Provident fund is to be increased by 5,000. Debtors are all good, therefore no provision is required on debtors. Stock includes 3,000 for obsolete items. Creditors are to be paid 1,000 more. Fixed assets are to be revalued at 70,000. Prepare journal entries, necessary accounts and new balance sheet. Also calculate the new profit sharing ratio. Okay, let's do this. So here we have two partners, X and Y, and their profit sharing ratio is 5:3. They admitted a new partner Z for 1/8 share in profit, and for this he is going to bring 20,000 rupees as his capital and 12,000 rupees as his goodwill. Okay, he is acquiring the entire share from Mr. X. Y is not contributing anything. Okay, so first thing is that we need to calculate the new profit sharing ratio, right? So new ratio. So here X, his original share is 5/8 and his new share, he is sacrificing 1/8 share to Z. So his new share is going to be 4/8. Why he is not having any change? His original share is 3/8 and he is retaining that. It's given in the question that he is going to get 1/8 share in profit. So based on this, the new profit sharing ratio is 4:3:1. Okay. Now we need to pass journal entries for the adjustments mentioned here. So first thing is the new partner is bringing capital of 20,000 and goodwill of 12,000. Okay, so let's pass journal entry for that. That is bank account debit to Z's capital to premium for goodwill. That is 20,000 and 12,000. So in the bank account we are going to get 32,000. Now the goodwill that is bought by the new partner has to be distributed to the old partner in sacrificing ratio. So in this case it is mentioned that the entire new share is obtained from X. So entire goodwill goes to X capital. Okay. So goodwill, premium for goodwill account debit 12,000 to X capital 12,000. Then there is many adjustments. Provident fund to be increased by 5,000. Debtors are all good, therefore no provisions is to be required. Okay, so what is the provision for doubtful debts? It's 600. Okay, let's try to pass all these adjustments in a single journal entry. Okay, so first thing is provident fund to be increased by 5,000. So when a provident fund has to be increased, the provident fund has to be credited. So I will mention to provident fund 5,000. Then the second adjustment says debtors are all good, therefore no provision is required on debtors. Now there are 600 rupees provisions. To write off provisions has to be debited. So provision for doubtful debts debit 600. Now let's go to the next adjustment. It says stock includes 3,000 for obsolete items. What do you mean by obsolete items? It means that stock is no longer useful. If it is medicine, the expiry date is gone, so it is no longer useful. So we have to reduce the value of stock by 3,000. So to reduce the value of stock by 3,000, we have to credit the stock to stock 3,000. Next adjustment, creditors to be paid 1,000 more. So again 1,000 rupees more we are paying to the creditors, that increases our liability. So that is credited to creditors 1,000. Then the next adjustment, it says fixed assets are to be valued at 70,000. Okay, what's the original value of fixed asset? 80,000. Now from 80,000 it is getting reduced to 70,000, which means there is a 10,000 rupees loss. So that fixed asset has to be credited by 10,000 rupees to fixed assets. Now 5,000 plus 3,000 plus 10,000 plus 1,000 plus 10,000, it totals to 19,000. 19,000 minus 600, it is 18,400. This 18,400 has to be debited to revaluation account. So we passed all the adjustments in a single journal entry. Okay, now let's have a look in the balance sheet. So balance sheet has workman compensation reserve 5,800. This has to be distributed. It has profit and loss account. This has to be distributed. Okay, and then there is always a revaluation loss. So here there is debit balance and revaluation account. This has to be distributed to partners capital account. So first we will distribute the revaluation loss. So X capital account debit, Y's capital account debit to revaluation account. 18,400 divided in the original profit sharing ratio, which is 5:3. That is 11,500 and 6,900. Now we saw two items, working capital reserve and profit and loss account in the previous balance sheet, that we have to distribute. So working capital reserve account debit, it's 5,800 divided in 5:3 ratio. So 2x capital to y's capital, going to be 3,625 and 2,175. Then we have profit and loss account that has a debit balance. So X capital account debit, Y's capital account debit to P&L account. P&L account, it is 2,400. This is distributed in 5:3 ratio. It's going to be 1,500 and 900. Now let's prepare revaluation account. So things that is there in a single journal entry, we have to put it in revaluation account here. So on the credit side, there is provision for doubtful debts, 600. Then Provident fund has been increased by 5,000. Stock has been reduced by 3,000. Creditors has to be increased by 1,000. Fixed asset value has reduced by 10,000. That will give a total of 19,000. We already calculated this. Then we have 18,400 as the balancing figure, which is the revaluation loss that needs to be distributed to X and Y in their original profit sharing ratio, which is 11,500 and 6,900. Now we need to prepare partners capital account. The original balance of each partner is by balance from the original balance sheet, it is X, Y and Z. Original balance is 70,000 and 31,000. Then Z is bringing his capital of rupees 20,000, and he also brings goodwill, which is completely given to X. Then working capital reserve is there, that has been distributed to original partners in the original profit sharing ratio, which is 3625 and 2175. Again, there was a profit and loss account balance in the original balance sheet that is distributed to X and Y in the original profit sharing ratio, which is 1500 and 900. Revaluation loss has been distributed, which is 11,500 and 6,900. Then the total of this is 85,625, 33,175 and 20,000. So we have 85,625, 33,175 and 20,000. So the balancing figure is 72,625, 25,375 and 20,000. So we've got the capital account balances. Now we need to find the new balance sheet. Okay, I will give you some time to look at the original balance sheet, and we need to arrive at the new balance sheet based on the original balance sheet that is given here. Okay. So the original balance sheet has cash at bank 5,000. Now we need to see what are the different cash transactions that's there in the journal entry. So here Z is bringing capital of rupees 20,000 and 12,000. So from the original balance of 5,000, we have 32,000 which needs to be added to the cash balance. Okay, let's see the other items also. There is sundry debtors of 20,000 and there is 600 rupees of provision. So this 600 rupees of provision is already taken out. That's because the adjustment says that there is no need to create a provision. The complete amount is good. So in this case, we don't have to create a provision. Okay, so let's start writing this. First is a cash or bank balance. We have 5,000 rupees as original balance and plus 32,000. It's going to be 37,000. And we have sundry debtors. The complete value provisions are not required, so it's going to be 20,000. Stock value has been adjusted and the new value is 22,000. Fixed assets. The value has been reduced to 70,000. And then we have creditors. Mentioned that it increased by 1,000 rupees, so it is 16,000. Provident fund has been increased, that is 15,000. Now we have the capital balances from the above ledger, which is 72,000, 25,000 and 20,000. So this we are going to write it here. X, it's 72,625. Y, it is 25,375, and Z, it's 20,000. Total of this is going to be 1,18,000. And balance sheet total is 1,49,000. Here also it is 1,49,000. So we completed question number 48. So friends, if you haven't subscribed to this channel, please do subscribe so that you don't miss on further questions. Thank you.